Hey everybody, um, welcome to the Thursday evening Financial Think live stream. I think my video may be frozen, so if I look like I'm frozen to you, let me know in the comments, and I'll unplug the camera and try to restart it. But I'm moving my hands around right now, so I'm presuming things are frozen. A little strange. Don't know why that's happening. But anyway, I hope you're all having a good week. So we'd hang on one second. Let's see what happens if I just bear with me for just a minute. Yeah, I think it looks like my video is frozen. All right, just bear with me. Let me unplug the camera. And solid as a rock. So yes, I'm frozen. Okay, bear with me for just a minute. I'll be right back. 1 second. So there we go. Okay. Nothing that a quick plug and unplug and a plug won't fix. Back to it. Let me turn up the volume here a little bit. There we go. Hope everybody's having a great... It was the budget shock. Hope you're having a great week. It's a very cool... I don't know, about 15 degrees here in Orlando today, so nice and sunny. As you can see the sun coming through. We got the dog here in the background attached to the leash, to the lead as we call it. What are we talking about today? Oh, yes, just before we start, if you go to the Financial Thing YouTube channel, first of all, hit that thumbs up if you can. Thank you for being here. Subscribe to the channel, all that good stuff. If you go to the Financial Thing website, the YouTube channel, you'll see here that I have put up a new video in the video section here called my 50,000, oh look at that guy throwing the chair, 50,000 pounds of premium bond purchase and how I hated it. It's a cool video, go check it out, watch it, you'll hear the story about what I spoke about last week, that think about 22-month experiment into premium bonds that was not the most lucrative buy in the world, but I think the results of that were definitely worse than other people that I've heard about who've had really good results. Yes, my results have not been very good, so I don't know, it is what it is, but yeah, go watch that video. Let me know what you think. Please leave a comment and like that video. It really helps out the channel a lot and allows me to continue to be here every week and to continue bringing you this content. But we're going to talk about peer-to-peer lending tonight. A little bit of news. I'm going to show you my top 5 reasons why I like and dislike peer-to-peer lending. So stay tuned for that. It's kind of interesting. Talk a little bit about the inflation numbers that came out in the UK CPI print, which was ridiculous a couple of days ago. We're going to look at the Trading 212 portfolio because I found a gem that either I just got very lucky, but I'm not sure I did. But I'm going to show you what was added to the portfolio that has been absolutely superb, and also one stinker that was added to the portfolio. So the portfolio has changed quite a bit. Probably need to make an update video. And then I'm going to talk a little bit about this FTX situation that is happening right now. If you don't know what that is, a big cryptocurrency platform, I think the 3rd biggest in the world, that has disappeared, gone under, bankrupt. It happened very fast within just a couple of days. And I'm going to kind of talk a little bit about cryptocurrency and what I feel about the asset class right now. So if you're interested in that, hang on till the end and we'll have a chit chat. So quick hi to everybody here. Mike Powell first this evening. Welcome Alan Toombs in a very wet Basingstoke. Colin Perry is here in the Peak District. Peter Vince, of course, the famous Peter Vince in Leatherhead in Surrey. We've got Paul Bagworth in Kenilworth. Alan Toombs is freezing. Everybody's freezing. I'm freezing. I went out on a motorcycle ride this morning. I was freezing. I needed the old flannel thermals. Alan is here in Worcestershire, from Worcestershire Source Land. Dave Ellard is here. Good evening. John Day in Nottingham. Annabelle Nyron, of course, in Spain. So glad everybody is here. I really, really do appreciate it. I don't know if I tell you this enough, but I'm just a regular guy, and the fact that you guys come here every Thursday really fills my heart with a lot of joy, and I just appreciate you guys coming here and watching this. And for everybody that's watching in the future, thank you. This is just a small channel. I'm not one of these big YouTubers. I do it because I love to do it. I love providing information for you and opinions and right or wrong. So yes, thank you very much. Very much appreciate it. So keep coming back, as they say. So let's jump right into it. Let me pull up the screen here. We're going to do a little bit of peer-to-peer lending news like we always do. Let me move this out the way over here. There we go. Crowd Property pledges not to increase borrower rates. Crowd Property has said it is not planning to increase its borrower rates despite recent economic uncertainty. Can I zoom in this? Yes, there we go. The only thing I will say about this article, Crowd Property saying recent economic uncertainty. I think this economic uncertainty has been around for more than recently. I think it's been around probably since the pandemic began in 2020, if not before that. In a November market update, the peer-to-peer residential development lending platform noted recent economic data from the Office for National Statistics, which indicate an upcoming recession. I think we're absolutely in recession right now. I don't think that the UK is having an upcoming recession if you look at all of the economic data that is out there. So, but these interest rate hikes are on the horizon to temper soaring inflation, which will put pressure on the housing market. Crowd Property cited the latest Halifax House Price Index, which recorded a 0.4% decline in house prices in October, while the annual growth rate fell to 8.3% from 9.8%. This is the sharpest decrease in house prices since 2021. A post-pandemic slowdown was expected, but the impact has been accelerated by recent events such as the mortgage rate increases followed by the mini budget, which have encouraged both those with existing mortgages and would-be home buyers to take a pause. Despite the challenging macroeconomic climate, Crowd Property says it has not increased and is not going to increase its rates for residential development finance. It's very interesting because you have to look at as interest rates begin to rise, and I think we're not done with these interest increases. People like Crowd Property have a certain spread in their product between what they lend out, the rates, and what they pay lenders, investors, and their rates are pretty attractive. We're talking about much higher than platforms like LoanPad. So it's interesting to me that Mike over at Crowd Property would say that he is not going to increase those rates, because I wonder if the interest rates start to get higher, which they will, like they are in the US, where mortgage rates here now, you can get a 30-year fixed mortgage rate and it's going to cost you over 7%, whereas that, has more than doubled since, rates were... And one time you could pick up a 30-year mortgage about 2.3% in the US fixed for 30 years. That kind of product is not really normal in the UK, but we've seen those increases, almost 3 times as much as it was 12 to 15, 16, 17, 18 months ago. So I find it interesting that Crowd Property is saying, well, we will not increase our rates to borrowers. I just feel like at some point they're going to have to do that if the interest rates continue to rise, because if they're going to continue to pay 8 or 9% to lenders, I think they're going to have to probably increase their borrower rates at some point. But according to this article, Mr. Bristow is not going to do that, which I find interesting. Rebuilding Society significantly amends credit risk processes. Speaking of Rebuilding Society, I'm really trying to get, I think, what is his name? The CEO, Rajiv Kumar, to come onto the stream. Him and I have talked briefly over email about him coming onto the stream, because I think he feels like I've been particularly hard on Rebuilding Society because of my early experiences. I would love to have him come on and for us to have a talk about the platform, where it's going, and kind of just have a general chit-chat about peer-to-peer lending. So I'm waiting for him to respond to see if he wants to come on the stream and do that. But if you look at this article, and this is the reason why I get concerned about Rebuilding Society, it says that the company has significantly amended its credit risk processes to account for the risks affecting businesses in the current climate. The peer-to-peer lending platform said it continues to lend, adding a new public loan just last month, but it suggested it will be taking a more prudent approach to loans in the future. During October of 2022, the platform funded one new public loan. This brings the total number of public loans made via Rebuilding Society since its inception. That brings the new loan count to 292. They have loaned out $16.8 million to small and medium enterprises. The total capital still out on Rebuilding Society loans totals $2.135 million. Of this, 11.79% is currently in default. £750 was recovered in October, while the platform received £452,000 in capital repayments and £29,594 in interest payments. We keep a rolling 12-month return figure to track profits over the last year. This month's performance brings the average to 1.87%. We've tracked net return for the lifetime of the company, and this figure remains consistent at 5.88% net return per year. I consider Rebuilding Society to be very high on the risk level of what you're lending to. I think some of the loans are pretty high risk. So 5.88% net return is pretty low considering that gap of risk. 11.79% is in default. And what's concerning is the lack of new loans that are being written. I mean, you're talking one new loan last month. The loan book is only $2.1 million. I don't know what Rebuilding Society's running costs are, but I do know that you pretty much need a loan book of over £10 million in peer-to-peer lending to be a profitable company. So this is why I have them pretty high on my website as risk. And if you are an investor in Rebuilding Society, you really do need to pay attention to these numbers and make sure you keep an eye on what's going on with them, because the risk, I would say the risk levels are high on that platform. Again, not financial advice. I don't know anything other than what I read into their numbers, but that's just kind of a gut feeling that I have and have had for a long time, and I haven't been investing with them for several years. I think in order for a peer-to-peer lending company to grow, they have to be writing new business and new loans, and only doing one loan. I don't know how much they've done over the last 6 months, but I think it's been very small amounts, so if any. So just keep an eye on that if you're a Rebuilding Society investor. Fourth Way names their top 6 platforms of 2022. So top 6: Capital Stackers, LoanPad, PropLend, Crowd Property, Cufflink. and Capital Rise. So 4 of those 6 are on my top 5 peer-to-peer lending list. That has not changed that much. If you don't get that list or you haven't gotten it, you sign up to the email list at financialthing.com and that will come through to you. But 4 of those top 6 on the Financial Thing list, which is good. Capital Stackers, I really don't know too much about them. And Capital Rise, I think, are doing good things. Personally, don't invest through them, but I think Capital Rise is doing good things. So I actually wanted to go and just take a look at Capital Stacker's website and sort of see how big their loan book is, see what they're up to. They must be doing some good things if Fourth Way has listed them as a top 6 peer-to-peer lending platform. So hopefully you can see these numbers. Zoom in here. This is loan data for 30th up to the 30th of September. So they have 14.4 million pounds of debt with 83.752 million pounds of external senior debt. They've got 17 deals written with 29 deals repaid. Average investment 102,000. 141 active investors, so not a big active community. It seems like those people are putting more bigger chunks because Capital Stackers does have a pretty decent minimum size. I think it's 2,500 if I'm not mistaken. Let's see here, yeah, £2,500 return. So when they're writing loans, it doesn't take much to fill those, so they have a relatively small active investor basis. They've got 100% into development loans, 88% residential, average term 21 months, the highest return 24.97%. I mean, that's pretty high. Average return 14.13%, lowest return 6.89%, with 0% provisions and 0% losses. So pretty impressive numbers as far as the loan book goes. They've got 2 loans that are more than 6 months overdue at 1.2 million pounds. So, I mean, the statistics look good if you're able to average a 14.13% return. That, yeah, you do have to think about what are they charging borrowers? What is their spread amount? I don't know. It's probably in their statistics sometimes. They have all these fancy charts here if you want to go through and read that. And I wanted to just kind of log in to their platform and sort of see what their dashboard is like. See if I can get in there and show you. I found it pretty simplistic. There wasn't really a lot of information. Let me log in. Hang on one second. They've got the 2-factor authentication, which I think is cool. So let me go ahead and put the code in. I think every peer-to-peer company now should be using that type of security on their website. As you can see, it's a pretty basic website. If you go to opportunities, yeah, so this would be where the loans are listed. You can see only one deal here. It says return 6.91% to 25%. So I'm imagining there's probably different tranches. I don't know too much about how they... Oh, is this completed? This may be completed. Let's see what the deal is here. So completion date. Oh, so the loan was completed April 8th and it repays 30th of June 2023. Let's see what people. Let's see if this works. It's pretty slow. It's got some good information here about. This is kind of cool. It shows you about the borrower details, who the SPV ownership is, so the company that owns Buildo. So you can see if you wanted to research them. It has the valuation. Since the valuation is 0, formal valuation, I don't know why that is. Monitoring survey. So it shows you something about the fees, how much the legal fee is, how much the valuation fee is, so what they paid for that. See what the property is. So, I mean, it has some pretty good in-depth information about the property. There's just not a lot of loans. Here you go. Pricing. It shows you what pricing is for that area. Funding summary. Yeah, so pretty in-depth information. I think it's pretty... I mean, these just returns sound so high, 14.1%. That I honestly, I don't know how their deals work. I don't know if they're equity shares where you get a percent of the profit, or whether it runs in tranches, whether they're second position loans. Could well be. I don't know. I'm sure somebody out there in the chat knows. But it looks interesting. It looks interesting. 2,500 minimum means that really you need to have a minimum, I would say, of 5 loans to have some decent diversification. So you're talking about £12,500 minimum investment. So it is going to be for those who want to put in some more cash as a higher allocation. But interesting. So on that fourth way list, again, LoanPad. Of course, you know, we talk about LoanPad a lot on the stream. Check out the interview with Louis, the CEO, from a couple of weeks ago. Propland, I've always said, I think Propland's doing good things. Crowd Property seems to be steady. And then Cufflink has been doing well. Capital Rise. So a good top 6. I would concur. I might also put Blend Network on that list. They would probably replace Capital Stackers. Just not anything against the company. I just don't know anything about them. But I would say Blend Network might be one of my top 6 for sure. And then also Unbolted, just because I think Unbolted is doing some favorable things in the peer-to-peer lending space. I noticed when I logged in to Cufflink the other day that if you're looking to put money somewhere, they have quite a lot of availability on their platform right now. You can see there's plenty of available live loans with just various different ratings of risk. We got some B1, B2 loans. I thought this was interesting that this loan right here is a B1 rating and pays 6.9%, whereas this is a B2 rating here, this Curtis Road, that pays 6.9%. So I'm not really sure why there is the same interest rate on one that's riskier than the other. So pay attention to things like that too. You got this B1 rating down here on Crossland Avenue that is 7.6%. I don't know if maybe it's a second charge loan. No, it's a first legal charge. So again, not really sure why these interest rates are different. Maybe due to what the buyer or the borrower is paying. But there's tons of availability here. You can just see these loans have availability. There was actually more yesterday when I looked. But one thing I like to do with Cufflink is sometimes just go through and look at their repaid loans, because sometimes we forget about how many actually loans these companies are writing and actually repaying. So you can see here, I mean, Cufflink has a really good amount of repaid deals. And it's good to see that. That is definitely what you want to see. They have 590 pages actually of repaid loans. That shows a sense of good completion history, which is very important when you're looking at peer-to-peer lending. For anybody new to this who's wondering what it is, go and look at the completed loans if you're ever thinking about investing through these companies, because they can be quite complicated. But Cufflink has a ton of repaid loans. In fact, just while I'm live in here, I do want to put a bit of money into, let's see, what we got live available. Curtis Road. I don't know if I put any money in that one or not, but oh, see, so tier 2, I'm imagining is probably a higher risk tier of loan. Maybe you're not. Maybe tier 1 is repaid before tier 2. So here we have a 7.6% here on a tier 2. So that's why I'm thinking those different B ratings are paying different prices of different interest rates. But yeah, lots of availability there. Moving on, Mintos is going to add car rental investments. For UK people, sorry, you will not be able to invest, but if you're out in the EU, you're an EU resident, you can invest in Mintos. They are a huge loan aggregator. They don't actually write their own loans, but they offer loans from other companies, other lending companies. But they are going to allow its users to invest in car rental products. Linked assets will be rental agreements between renters and the rental company. They are also going to have buyback obligations from the rental company. Now, buybacks sound really good. Let's take a look at Mintos. I used to invest through Mintos, and I was a big fan because of the buybacks. I thought, oh, what could go wrong, right? They've got these buyback guarantees. And again, I hate when these peer-to-peer lending companies use the word guarantees. It is, I think, very misleading, because when I was young and naive, let's see, can we browse listings? Yeah, when I was young and naive, I thought that those guarantees were actually real guarantees, that the risk was very low. I was going to get my money back if the lender or the borrower didn't pay. The issuing borrowing company was going to guarantee those loans, but what ended up happening is the borrowing company ended up folding in some cases, and those guarantees then became worthless. So if you ever invest through a company that has buyback guarantees, just be aware that those guarantees can actually mean very little if the company offering the guarantee ends up going busto. So they used to have a way to select that you could, select just terms with buyback guarantee, but I'm not sure what they do now. Investment structure. I don't know if they've changed it, but Mintos is always one of those companies that just has so many loans available. You can see right here, 35,817 loans. I mean, the interest rates are just crazy. If you sort by interest rates, you can go from as low as a 5.5% with a risk of 7, all the way up to 21% with a risk of 6. So they're very hard to assess risks, I think, if you're investing in Mintos. A lot of the times you just have to close your eyes and kind of go in and hope for the best. Probably a good idea is just research these companies here that are lending or doing the borrowing. Just make sure that they are legit. Remember, you're dealing with European companies, so they have as much risk of problems as I think the UK companies do. But I think those rental car agreements are interesting. The thing about rental cars, rental cars itself, I don't think this is what the investment is, but rental cars are obviously going to lose value, so I'm not sure if there's any type of security guarantee in those structures. I would imagine that they would be unsecured. It doesn't really say. I mean, if you secure it with the rental car itself, that's some security, but again, rental cars really do depreciate quickly, so as long as it's a short-term loan, I don't think it's too much of an issue. But it's an interesting product. Mintos is always adding a lot of different products, which I think is kind of cool. They have invoice financing, mortgage, pawnbroking loans, personal loans, short-term loans. See what kind of pawnbroking loans. Goldfin market right here at 20%. These are 6-month, I would imagine, pawnbroking loans. So if you are in the EU and you want to have some different type of lending, Mintos definitely has that. So, and also you get this tax break now that the Latvian government has reduced taxes for gains on peer-to-peer lending. So because they're based in Latvia, Mintos, you won't have to pay as much tax if you live in the EU, only I think 5% capital gains instead of 20%. So it does make some sense. You just got to watch out. Be careful with the loans that you invest in. This is a report that I didn't buy because it was $5,400 to buy the report. And as much as I love you guys, that's a pretty hefty price to pay for a bit of market research. But here the title is Global Peer-to-Peer Lending Market to Reach $220.3 billion by 2021. Sorry, 27, 2020. 2027. It's growing at an ACAGR, which I'm imagining is, I don't know what that means, ACR, 23% over the period of 2020 to 2027. So it's a growing number, and this report shows that it's healthy. The peer-to-peer lending market is healthy. U.S. market is estimated at $14.3 billion. I don't know. It would be an interesting read. I mean, if you want to buy it and read it, if you're that interested in it, you can go to reportlinker.com and you can buy it right here. It is only $5,450 US, but I can tell you that peer-to-peer lending is growing. It's a growing market, so that would be a good thing. I like to see reports that are showing that the peer-to-peer market is growing. So, moving on. Do a little, my top 5 likes and dislikes of peer-to-peer lending. Would you like to know? Here we go. Hopefully you can see this. I put together a nice PowerPoint presentation for you. No expenses were spared on this presentation, which is not true at all. It's just a black and white. First, like interest rate payments, of course, of peer-to-peer lending. Isn't that the reason? I mean, one of the reasons. It's not the only reason, but it's the main reason I think people invest in anything. For all being honest, is that it's off the side of the screen a little bit, but hang on, see if I can zoom it. Come on, zoom out. No, I'll read it to you. You'll be able to read it. The possibility of earning attractive returns. Let me see if I can do this instead. There we go. Possibility of earning attractive returns. I think there is very few places where you can earn attractive returns that pay anywhere from 4% up to, if you want to go super high risk, 25, 30% in peer-to-peer lending. And there's just not that many investments without really gambling, I think, that you can get those types of returns. Of course, you could do stocks and things like that, but there's some major risk when it comes to that. You can also lose big amounts in that way. Number 2, peer-to-peer lending companies are not the banks. Banks in the UK have no rules that require holding a percentage of deposit, which is called fractional reserve banking. This is one of the things that I have the biggest problem about with our banking system is that if you deposit £1,000 into the bank, whoever it is, Barclays, NatWest, your high street bank, any UK regulated bank, that bank has no obligation to hold any percent of your deposit on its reserves to give back to you. They're free to lend that entire £1,000 up to infinity out as loans. Now, the problem with that is if there is a big run on the banks, like we've seen previously in the past in certain countries, Iceland comes to mind. Cyprus, I think, had an issue like that. People want their money out. You go to the bank. Everybody goes to the bank at once, tries to get their money out. Well, guess what? Your deposit's going to be frozen because those banks do not have the money to pay you back because they don't have to hold any in reserve. It's called fractional reserve banking. I think it's one of the most important things you can learn about when it comes to money, just knowing your risk. So that's the second thing that I like about peer-to-peer lending. They aren't the banks, because I'm not a fan of the banking system. Number 3, that when we do peer-to-peer lending, we're helping businesses and developers. So we're helping British businesses, small and medium businesses get financing by providing capital to them, and we're helping property developers put up housing in the UK and other parts of the world, which the UK has a very big housing shortage. It's unaffordable housing. So we're allowing more of these houses to be built with our investments, which I think is a really cool thing. I guess I missed number 4, but you see it. Number 4, I get to control my investment appetite. Whatever I decide my risk appetite is, I can do that through using different peer-to-peer lending companies. And I think there's less volatility in peer-to-peer lending, and you can adjust your portfolio anytime. If you feel like, oh, I've got too much money in risky loans, you can, in some cases, sell out on secondary markets and adjust your portfolio, your risk appetite very easily in most cases, as long as there's liquidity. And I think that's really good that you can control your investment appetite in that manner. I think it's much harder to do with stocks, a little bit easier to do with stock funds, but definitely harder to do with stocks, I think, because I mean, you've seen some of the volatility in the stock market on big companies, like blue chip companies. We saw Walt Disney drop 12% in one day, which I consider a less volatile stock. So now the stock market has changed. The volatility has gone way up. I think with peer-to-peer lending, your volatility is just not the same. I think it's much lower. Things tend to stay very constant. And number 5, I think peer-to-peer lending is very innovative with the fintech, with the development of the different products and the websites. I like that merging of the technology and the finance together in one. I like the way you know the secondary markets where you can exit if the liquidity is there. I think that's really good innovation. So what don't I like? Let's go on to my dislikes. Number 1, losses from unscrupulous people. Of course, me being an investor in early days of collateral loans, savings stream, Lendy loans, funding secure loans, Wellesley and Co., very early days, but obviously there's been some unscrupulous people that have started these companies and which have led to losses for people who have invested into those loans and so far have seen very little money back. Now, of course, the one argument is here, look, this can happen in any type of sector, any type of finance business, any type of business in general. We've seen big companies go bust before. We've seen crypto companies go under. We've seen just regular Enron. These big companies go bust because of unscrupulous people. So unfortunately, that's part of the risk of investing. And that would be my biggest dislike, of course. Number 2, it's very, very hard to assess loan risk, at least for me. When you look at a peer-to-peer lending loan, so for instance, if we go back to these cufflink loans, it is quite difficult to assess exactly how much risk you're taking based on what you're being paid. And especially if you're inexperienced going through these loans and really figuring out, is this a 7.2% risk loan? Like, am I taking more than 7.2% of risk, the equivalent? I think that's very hard to assess, especially with other peer-to-peer lending loans, things through Assets Capital, and when you're loaning to businesses. You can look at the numbers, but all those numbers are just numbers that have been provided from those companies, and we don't know if they're really accurate or not. And sometimes we don't know a lot about the borrowers itself, so that is one of the things I would say is one negative about peer-to-peer lending. Number 3, it can be very time-consuming. If you're going through doing your own self-select loans, you want to, you're putting in any significant amounts of money, you want to do your due diligence on these loans, you're going to have to go through and do research, and that can be time-consuming. Of course, we have companies like LoanPad, Easy Money, where it's put your money in, automate it, Assets Capital, so auto investing, which you're going to get paid less for products like that, but it does remove the time-consuming factor, which I do like. So I used to spend tons of hours researching peer-to-peer lending loans, which I don't do anymore. I prefer to use the auto products. I just don't have the time. But peer-to-peer lending can be very time-consuming. Number 4, there is sometimes a lack of transparency in data from these companies. Not every company is like that. Some are better than others. some of the peer-to-peer companies, they make it quite difficult to find their statistics, and there's different levels of transparency on loans that are provided from company to company. And that can be quite frustrating if you really want to dig in and find the numbers. If you're doing auto lending, it doesn't really make any difference to you, but loan-wise, it's nice to have the data about the peer-to-peer lending companies itself to see how big their loan book is, see what's going on with them. But I think sometimes there can be a lack of transparency. And number 5, lack of long history. With the only Zopa being the oldest peer-to-peer lending company dating back to 2008, with most of the other companies coming in a much shorter time range, probably within the last 5 or 6 years. We just don't really have a long track record when it comes to peer-to-peer lending. So it's not like, traditional companies. You can look back decades of history, or funds maybe that have been around since the 1970s in the stock market. You have this long history. Peer-to-peer lending is a new sector. It's very young. It's very innovative. It's only spawned because of technology, quite frankly. I mean, if technology didn't exist, peer-to-peer lending wouldn't exist, other than private loans that singular people were giving out through family money. But we have this technology jump, and now peer-to-peer is here. So once that track record history starts to expand out, that will become struck off this dislike list. But that is one of the things I do dislike, is some of the companies do not have a long track history. So that's my 5 things that I like and dislike about peer-to-peer lending. Tell me what your number 1 dislike and like of peer-to-peer lending is. Put it in the comments to see what you think. A little bit of economic news. We have to look at the consumer price index that came out for October of 2022. This was just released 16th of November. Shocking numbers. CPI inflation rates from year on year, 12 months to October 2022, up 10.1%. I mean, actually 11.1%. So something that cost you £100 in October of 2021 is now costing you £111 in October of 2022. And these are crazy numbers. I think if I had to look into my crystal ball, I would say you should see a cooling of that number in November. I'm not convinced that might happen in December, but it tends to, again, follow what's going on in the U.S., where we saw the cooling of the consumer price index inflation numbers from this month's report, which was last month, to 12 months ago, and the month before things started to come down. But this is a big problem. This is why I say, look, recession is obviously here. People are under a crunch. Everything is costing more. You can't deny it. It's crazy. The consumer price index, including owner-occupiers' housing costs, rose by 9.6% year on year to October 2022. So housing is increasing. Everything is increasing. Fuel, gas, energy, everything. And these increases in interest rates, I think, are going to have a minimal impact on these rates. Again, I've said this before. I think the only way to get a handle on this inflation is to remove the money out of the markets, and do that by having banks holding bigger reserves, because right now they have 0% that they have to hold. But if the government were to say you need to hold 25% of your deposit in cash as a reserve, that would remove 25% of the cash out of the market that these banks are lending and investing into the market. So it's going to have a negative, detrimental effect if that were to happen. So it's likely not going to happen, but these inflation numbers are not good. And then we see articles like this: the number of millionaire pension pots fall by a third. This is obviously, some of this is due to the stock market detracting. This is numbers from the HMRC. So there were just 1,700 pension pots that were worth more than £1 million last year, down from 2,700 pension pots. I think this was also people taking money out of their pensions because they need it, for living expenses because of these inflation rates are rising. But we definitely have some problems out there. Yeah, if you're enjoying this stream again, please hit that thumbs up. I appreciate you being here. Just a little I need a sponsor. If anybody out there wants to sponsor the YouTube live stream, come sponsor it. We used to have a Cufflink. They were a sponsor here for a year. I guess this week it is sponsored by financialthing.com. Who knows? Okay, let's look at the Trading 212 portfolio. I hope you enjoy looking at this. I don't know. I kind of get a kick out of it. This is never designed to be... sometimes I feel funny about showing this portfolio because I'm not here to brag about it. I want to show you, the realities of the pluses and losses. And again, I do give a portion of this to charity every year, so it is a good thing. We're about 19,300 pounds. That did go up close to 20,000 at one point, but we had that pullback in the markets. And you can see the positions here have changed just a little bit. I've added a Deutsche Bank position. It's sitting right now with about 6,500 pounds in cash, so a little over 12,000 invested. But I did put some more into Deutsche Bank, which is really around zero, hasn't really done much. And here's one of the holdings that was added that has not done very well. This is Ginkgo Bioworks Holding, which is a biotech, very small cap company. Let's see if I can show you that. But yeah, we've had a pretty bad run with it since bought in. I mean, just down 8% today. I didn't put in too much into it. Put about 1,000 pounds. But on the other side of things, Kalera, which is another U.S. stock, very small market cap, which had a massive day today, up 20%. But this has gone up 50% since, when did we buy that? I think the 11th of November. You can see here we sold out of Consol Energy and Arch, kind of gave up on the coal, bought 1,000 pounds of Kalera on November the 11th, and then bought another 300 pounds on the 15th of November. You can see the positions that were added here, but this Kalera is just absolutely taken off. I started looking at this stock when it was 80 US cents. And if you look at where this stock used to be, it used to be $18. So that's a crazy pullback. And price target on this stock, for me, is about $4 US. So we'll see what happens with it. I think we bought in when it was 89 cents here. So had a really good run. Now, please don't follow this. This is not investment advice. I have to say this is just me and what I do with this portfolio. But I think this stock has a good possibility of hitting that $4. Now, problem is, if you see a stock doing these crazy jumps in a short period of time to go from here 65, see where it was at its very low point. If I was a genius, I would have bought in at 60. But to go from 60 to 135, I mean, you 100% doubled in, what are we talking about, 9 days? Warning flags start flashing in my head. Like, this is not normal. Even though I think the stock is undervalued, I just don't think it's normal for a stock to be raging that hard. So if this thing were to go down 30% tomorrow, I would not be surprised at all. So that one has done well. We got Norwegian Cruise Lines at negative 1.8%. I added to the VET, the Vermilion Energy, which is red, 3.8%. Walt Disney down 10%. And then Zim Integrated Shipping. So pretty interesting mix of companies, a bit of banking, some energy, some bio. Kalera's in the tech and providing information. So, and then Walt Disney. I just think Walt Disney has got room to grow, but they did have some bad earnings reports, so we'll see what happens with that. And then some shipping. So really diversified portfolio with some chance to really grow. Kalera, by the way, a very small cap company, I think valued at less than 40 million US dollars. So volatility is going to happen with a company like that. And then finally, FTX. If you haven't heard about this, you probably were under a rock. This is a huge cryptocurrency platform where they literally went from being solvent to becoming unsolvent in less than 3 days. I'm not going to go into the whole story, but if you want to read about it, you can just Google it. There is definitely allegations of criminal behavior. Money has disappeared. This guy, Sam Bankman-Fried, under the microscope. There's talk about regulators looking into criminal liability surrounding the company. Reports emerging that 10 billion US dollars was transferred from FTX to its sister company, Alameda Research, before FTX went bankrupt. I mean, you just can't move that amount of money without it being traced. So I don't know what this guy thinks he's going to get away with. But this company was once valued at 32 billion US dollars, and I mean, it just literally disappeared overnight. A lot of people are going to lose money on that platform. So I've been getting asked a lot, hey, we're seeing a bunch of just crap happening in the cryptocurrency market. You know, what do I think about cryptocurrency at this point? I've always said this. I think that 99% of cryptocurrencies will fail. That's why I've been more of a believer in Bitcoin and to some extent Ethereum and probably nothing else. Even though I do own some other things, I do fully expect that probably some of them are going to go to zero. And but as far as the actual cryptocurrency itself, this FTX situation, just like Celsius, was a platform problem. It was it'd be like if you invested in, say, stock trading company Alpha, and stock trading company Alpha went out of business, and you had stocks that just completely disappeared. Yes, there is a way to get those back, but it is stock company X that went out of business. It wasn't anything to do with the stocks that you owned that were a problem. It was the company itself. And this is the problem with these platforms within crypto. And this is why I always say, make sure you hold your own cryptocurrency on your own wallet, and then this can't happen to you. This could happen to any crypto platform, like even Coinbase. I don't think that's going to happen. They seem to be in a different league when it comes to holding assets, but still, it's still unregulated. Could happen to Binance. It could happen to Coinbase. It happened to FTX. So, I mean, the fundamentals, say, for Bitcoin have not changed at all. It's the same asset. Nothing in the fundamentals has changed, which is why I still continue to hold it. Yes, it's taken a battering because things like this, these platform failures, just like peer-to-peer lending, when peer-to-peer lending platform fails, what happens to money? It comes out of peer-to-peer lending and goes into other places because people get scared. But the fundamentals of Bitcoin have not changed at all. Once these companies and these bad, unscrupulous people wash through, people do have short-term memories, and I believe that Bitcoin will continue to thrive. It's the same old story. When everybody's full of fear and things are not going well, they exit. And then when things are going well, things are increasing, you're getting big gains on things, the money piles in. Now, that's not to say there is no risk. Cryptocurrency is having major problems right now. And if companies like this continue to go out of business and people lose money, it may take a long time for things like Bitcoin to bounce back. But the fundamentals have not changed. This is not a black mark on cryptocurrency, things like this FTX situation. This is a black mark on the people running the companies that are providing the products, like you being able to sell and buy this cryptocurrency. So, as long as this type of thing exists, I think you're always going to have a black mark in some ways. It's going to hurt the cryptocurrency business and industry. But what I think is going to happen is you're going to see regulation start to roll out soon enough, because things like the Security and Exchange Commission in the US, probably the FCA in the UK, are going to want to see things like this stopping. And that's where the regulation will come in. Stronger regulation will prevent, it won't completely stop it, it will prevent things like this from happening, which is what needs to happen. Cryptocurrency is very young, and regulation needs to happen. I used to be against regulation, but after seeing all these things, happen, things like FTX and Celsius, and then we lost BlockFi, we lost Voyager, it was bad. But regulation needs to happen, and once that happens, I think you're going to see things like Bitcoin really take off. Now, it's not for everybody. There's going to be a lot of people out there that say it's too risky, it's not worth anything. But if you understand the fundamentals behind it, you may have another opinion. But again, not for everyone. I certainly wouldn't put my entire life savings into it. So really a shame, very sad what happened to FTX. As time goes on, we're going to find out what happened. Hopefully, whoever was behind any type of fraudulent activity will come to justice, and hopefully some people will get some of their money back. I hope so. It's very, very sad. Anyway, that's my take on it, for better or for worse. How long have we been going for? Wow, over an hour today. Way too long. Let's see if you have any interesting comments. Two more cryptocurrencies in trouble. BlockFi goes bankrupt. Yeah, BlockFi was pretty much funded by FTX. So I was going to have, and Genesis suspends withdrawals, which hits Gemini and others. That's a shame. Gemini was the Facebook guys, the Winklevoss twins. And that's going to happen. It's just kind of like this trickle-down effect. I was going to say, if you hold cryptocurrency, take it off the exchanges and put it on your wallet, your own wallet. Alan, I've noticed not so much money flowing into crowd property from investors lately. Must be something to do with the economy. Yeah, I mean, economy is in really bad shape. No matter what the news stories are telling you out there, it's dog poo. So people, when the inflation raises, are going to have less money, and people will get scared too. Hey, Aki Chap, how are you? I'm going to go through these comments very, very quickly because I don't want to be here too long. I'm sure you don't. I'm sure you have better things to do on your Thursday evening. Let's see. Richard Madhu, I'm still in Pit-to-Pit, but withdrawals repaid and reducing my risk. It was a different game start of the year, but now plenty unknowns in Pit-to-Pit. First, security and low loan-to-values are essential. I think that's a good basis to go off. I think you'll see interest rates in Pit-to-Pit lending start to increase too. Good comments. ACGR annual compound. Alan says ACGR compound annual growth rate. Or is it annual compound growth rate? I'm sure it is. Oh, CAGR. Okay, you got it right. I haven't been talking for an hour. Streaming includes the whole. That's true. Well, it's 8:29, so you're right. Coming up to an hour. So, that being said, I'm going to get out of here. I got to take the dog for a walk. You see she's getting restless. Thank you so much for being here. I hope you enjoyed it. I do have, just a little side note. Easy Money, I've been communicating with them about coming on the stream. So I'm very interested to hopefully bring that to you. I don't know if it'll happen this month, but possibly in December. But please tell your friends and family about what we're doing here. Send them to the YouTube channel. Spread the word for me. It helps out a ton. Hit that thumbs up. And I will see you next Thursday, God willing. You have a wonderful weekend. It's really a pleasure to be here with you. And I will see you guys soon. Have a great night. Bye-bye.